The way I valued the business I bought was to use the profit multiplier method. But before I explain what that is and how this method works, it's important to define what a small business is. The definition of a small business depends on who you're speaking with or who's defining it. But for the purpose of buying a small business, I define it as a business with sales of less than $10 million or pounds, but ideally a business with sales of between $1 and $5 million or pounds. The business I bought had sales of about $2 million or 1.6 million pounds. So its sales sat perfectly between the $1 to $5 million range. The profit multiplier method suits this type of business, which is because you are effectively buying its future profits or future cash flows. So you need to attach a value to those future profits. I would therefore suggest the best way to value a small business, especially when you're buying profits, is to use the profit multiplier method. But also, this method of valuing a small business is probably the most recognized and most popular way to do so. But just because it's the most common way to value a small business, it doesn't mean that everyone who uses this method will use it in exactly the same way. I explore this point further in this video, but first let me explain what the profit multiplier method is. The profit multiplier method is where you take the profits of the business and multiply these profits by a number or the multiplier. Now on the face, that sounds simple, when actually it's not as straightforward as it first appears. And let me explain why. The first question to ask is what profits should be used in the valuation calculation when using the profit multiplier method. You may say, surely profit is profit, but profits are not always equal when it comes to business valuations, as believe it or not, there are many different profit figures. These various profit figures include gross profit, profit before tax, profit after tax, EBIT, which is earnings or profit before interest and tax, EBITDA, which is earnings or profit before interest, tax, depreciation and amortization. And then there's SDE, which is seller's discretionary earnings, which is EBITDA but with the seller's earnings and benefits added back and adjusted for non-recurring income and costs. But actually, none of these are the right profits to use to value a small business. And it's important to use the right profit figure to avoid over or under valuing a business. The other complication with choosing the right profit figure for business valuation purposes is that profits of a company are never the same from one year to the next. Profits fluctuate as you'd expect. So, which profit do you use? And as profits fluctuate from one year to the next, how do you calculate a profit figure to use? The best profit to use for small business valuation is to start with EBIT, which is earnings or profit before interest and tax, and then adjust this figure with various add-backs and deductions, which is similar to but not exactly the same as SDE or seller discretionary earnings. Don't use EBITDA, which is earnings before interest, taxes, depreciation and amortization, to value a small business when using the profit multiplier method, as many people suggest you do, because if you add back depreciation and amortization, you'll overvalue the business and you'll end up overpaying for the business too. To arrive at EBIT, you need the financial statements for the business for at least 3 years trading. Then turn to the profit and loss page of these financial statements and look for the line described as profit before tax, which should be fairly easy to find. On the same profit and loss page, you should also see disclosed interest payable and interest income. Deduct from the profit before tax any interest income and add back any interest paid, and this will give you your EBIT number. Do the same exercise for all 3 years of trading. Then ask the seller for details of amounts they paid to themselves from the business, including any payments to members of their family if these family members won't be carrying on working in the business post-sale. You need details of their salaries or wages, benefits, company car costs, pensions, and so on. These are all those costs that will disappear once a business is your company. Add these amounts back to your EBIT number for each of the 3 years. Then review the profit and loss for each of the 3 years and look for any income or costs that are likely to be non-recurring. Non-recurring costs would include one-off legal costs, bad debts, excessive repairs or refurbishment costs, losses on the sale of equipment, and so on. These costs need to be added back to the profit for each of the relevant 3 years of trading. Non-recurring income might include profits on the sale of equipment or any other income that's a one-off. This income needs to be deducted from the profits for each of the relevant 3 years of trading. You now need to estimate the costs associated with replacing what the owner does in the business, as this work will still need to be done after they've left and you own the business. If there's more than one owner, the same applies for all owners, as it's important to know what they each do in the business and what this will cost to replace them once you've bought the company. Calculate a salary for the role of the owner or owners together with any associated employment costs and deduct this amount from the profit figure for each of the 3 years. So, now you have 3 years of adjusted EBIT profit figures for the business. But now you need to decide which of these to use to value the company. You could use a simple average of all 3 years by adding the 3 years' profits together and dividing by 3. Or better still, you could use a weighted average calculation instead. If you use a weighted average calculation, I suggest you give the last year a higher weighting versus the older 2 years, and perhaps even use a 70% weighting for the latest year, 20% for year 2, and 10% for year 3. But there are no hard and fast rules on this calculation. You also need to be mindful about giving too high a weighting to a year where the profits are unexpectedly high or unexpectedly low, as this may distort your profits and therefore distort your valuation too. Business valuation is not an exact science, so it really boils down to what you are prepared to pay for the business. But it's also about how you intend to fund the acquisition too, as the amount you agree to pay for the business will impact on how you fund the purchase. Next is how you calculate the profit multiplier. But before I explain this, as a very quick aside, I have a great tool you can use to help you value a small business, which is included in the business buying system. This tool makes the calculations of business valuations far easier. I've included a link to the business buying system in the description below. The other option you have is to take a look at my course, which is the 5 steps to buy $1 million business, which not only includes lessons on how to value a business, which is one of the 5 steps, but it also includes the business buying system as a free download too. I've also included a link to this course below, which includes a free training video on the 5 steps to buy $1 million business. So back to how you value a small business. So now that you have your profit figure for valuation purposes, you need to ask the next question, which is, what multiplier do you use to multiply the profits you've just calculated? How do you determine this number? Calculating the profit multiplier is very much a subjective process. For example, I'm sure if you had a room full with entrepreneurs and business brokers, each one would probably use a different number, as a profit multiplier for any given business. The factors considered in arriving at a profit multiple include the size of the business, where, for example, the bigger the business in terms of sales and profits, normally the higher the profit multiplier and the greater the business value. The business sector can affect the profit multiplier. Reliance on the owner will affect the profit multiplier, where the more reliant the business is on its owner, the lower the multiple and therefore the lower the business value. There are no hard and fast rules how you determine what the profit multiplier should be, but also so long as the business has sales in excess of £1 million or dollars, it has profits of at least £100,000 or dollars, the business isn't too heavily reliant on the owner, and assuming the business or the business sector isn't too volatile, plus the business's sales do not comprise more than 10 to 15% from one customer, you should be looking at a profit multiplier of between 2 and 3 times profit. I suggest for small business valuation purposes, you don't use a profit multiplier of greater than 3, but it's likely to be more than 1. And that's not to say it can't be lower than 1 in certain circumstances. It just depends on the business and the surrounding factors. You may argue that this is way too vague, and you'd be correct, but I'm afraid that's how it is. Having said that, let me try to help you further. If you are looking to buy a business and you want to avoid paying too much for it, I suggest you set a range of prices between 1 and 3 times the profit figure that you just calculated. For example, let's say the adjusted profit figure for a business you're looking at is, say, £200,000. Equally, that could be $200,000 too. If the profit multiple is 2, the value will be £400,000, which is 2 times £200,000. But if the profit multiplier is 3 times, the value will be £600,000, which is 3 times £200,000. You now have an upper valuation figure, i.e. £600,000, and a lower valuation figure, i.e. £400,000 for this business, which are numbers you need to calculate before you meet the owner to negotiate on price. When you meet the owner and ask them to reveal how much they want for their business, you have your upper and lower range numbers in your pocket to compare with the number revealed by the seller. If the number they reveal is below your lower limit, you know you have a great deal. If this is the case, you now need to negotiate how you pay for the business. If their number is somewhere between your upper and lower values, you may still have a good deal, but you may want to negotiate them down at this stage. It's important to highlight at this stage why it's important you get the owner to reveal their number first. If they go first, the only way negotiations can go is down. In other words, if their price was, let's say, £300,000, you might be able to chip them away to take that number down. But also, let's say you went first and revealed your lower valuation of £200,000. But what if the number the owner was about to reveal was £150,000? This negotiation has just cost you an extra £50,000. Also, if you go first, the only way negotiation can go is up. So for example, if you reveal your lower price range of £200,000, they may try and push you up above that £200,000. So you must stand firm and ask the owner to reveal their hand first. And even if the business has been valued by a business broker, ask the seller what they think the business is worth, because they may not agree with the broker's valuation. Finally, if the valuation number they reveal is higher than your upper valuation amount, you now need to negotiate the seller down. But if they won't budge to a more reasonable number, you should consider walking away from the deal, to avoid overpaying for the business. It's important you get comfortable with the amount you pay for the business. But as already mentioned, there is a second element to this part of the negotiation, which is how the agreed price will be paid and over what period. The ideal scenario, and a win for you, is to negotiate seller financing to fund the acquisition. But seller financing isn't just a win for you, it's also a win for the seller too. The seller benefits because they actually get to sell their business. Otherwise, they might not sell at all. But also it means the transaction will happen far quicker than if it was financed by a bank loan instead. You may then ask, is there a more simple way to value a small business? Well, I think there is, but only slightly, and it goes something like this. For this to work, you need to ask the seller how much money they need to earn once they've sold their business. This is best explained by way of an example. Let's assume that the seller needs to earn £50,000 or dollars a year once they've sold their business. Let's also assume they can invest the sale proceeds and earn, let's say, 5% on their money. This would mean they need to sell their business for £1 million or dollars. But if this is a profitable business making profits in excess of, say, £350,000 a year, a 3 times multiple will work in this case. In other words, 3 times £350,000 is £1,050,000. However, if the business doesn't warrant a 3 times multiple, or in other words, it's not worth £1,050,000, the owner will have to realign their expectations and accept a lower price for their business when it's sold. Unfortunately, no matter how simple you want the valuation process of a small business to be, you can't get away from the starting point of having to calculate a profit figure. Having a profit figure is the starting point of all negotiations, and in this case is the calculation you need to do to confirm if the amount the seller needs to invest to achieve what they need to earn is reasonable. To sweeten the deal for the seller, you could offer to pay a higher rate of interest than the 5% they get from a bank on the amount financed using seller finance. At the end of the day, if you are looking at a good, profitable business, and if the owner is willing to offer seller financing, and so long as the business itself is sound, you can't go too far wrong by paying a multiple of profits of somewhere between 2 and 3. So long as when you arrange the seller finance, the payment period is such that the business can afford these repayments. If you have any questions on this topic about buying a business or in any other aspect about the process involved in buying a business, please drop a comment below. And always remember that no question is a stupid question. If you don't know it, you don't know it. And by having the answer to a question you have might be all it takes to move to the very next step in your journey to buy a business. Take care, and I look forward to seeing you on my next video.